While we've been clear with Canadians that they should expect a rising path for interest rates, seeing their mortgage rates and other borrowing costs increase can be worrying. We will be assessing the impacts of higher interest rates on the economy carefully. We also discussed where rates might end up. How high will they need to go? I know many Canadians have the same question, so let me share the Governing Council's thinking. Canadians should expect interest rates to continue to rise toward more normal settings. By more normal, we mean within the range we consider for a neutral rate of interest that neither stimulates nor weighs on the economy. The neutral rate isn't something we can measure directly. We have to estimate it. And our estimate is between 2 and 3%. Today, we raised our policy rate to 1%, still well below neutral. This is also below the pre-pandemic policy rate of 1.75%. We do see the need for interest rates to rise further, but we're not on autopilot. We're not headed to some preset destination for interest rates. We have an inflation target, we don't have an interest rate target, and we will be assessing how the economy is responding. We will be looking at the impact of higher interest rates on Canadians. We are very aware that Canadians' households on average are relatively highly indebted. Year-over-year inflation, which is our target, how we typically measure inflation, of course, the year-over-year builds in a considerable amount of smoothing. There's a good reason for that. But if you want a kind of a leading indicator, you can look at the quarterly rates of inflation and annual rates, which are in the chart. And what you see is in the second half of the year, those start to come down pretty quickly. And that's certainly something we will be watching for. Is there clear evidence that inflation is coming down? Are we getting close to our target? And that will be that will really be an important indicator to us on where we need to take interest rates to bring inflation back to target.